I bought at the IPO, Sri Lanka's biggest IT retailer. Everyone knew the name. I held 2 years thinking long-term. I lost 90%.
That is not fiction. Thousands of CSE investors live that story. The reason they lost is the same reason investors lose in every crisis, including this one.
Welcome to another Optivest Deep Dive. We're looking at a really specific stack of sources today.
We are.
Yeah, we've pulled historical Colombo Stock Exchange filings from 2010 to 2013, the original IPO prospectuses, corporate annual reports, and we're cross-referencing all of that with current IMF risk assessments regarding the 2026 energy shocks.
Right, because the goal here is to take all this raw market data and, distill it down so you can actually navigate the market with absolute clarity.
Exactly. But before we get into the mechanics of what went wrong back then, I want to ask you, the listener, a question. Like, right now, look at the biggest holding in your portfolio.
Yeah, picture it.
At what specific business condition, not a price target, but an actual fundamental business condition, would you sell it tomorrow?
And, look, if you are hesitating right now, or if you are mentally checking a stock picker instead of picturing a balance sheet, you are exactly who we need to reach today.
For sure.
Yeah.
Because our mission today is to forensically examine the PC house collapse from a decade ago.
And we are not doing this as a history lesson. I want to be clear about that.
No, not at all.
We are breaking down the financial plumbing of that collapse because it serves as a literal survival guide for the current 2026 macro crisis.
Right. And to really grasp the severity of this collapse. I mean, we first have to understand the blinding hype that trapped so many investors in the first place.
You don't get a catastrophic loss without a massive buildup. It just doesn't happen.
Yeah. So the story of PC House, it starts in 1997. The founder, Rishan, who was the son of a postman, he starts in this humble 100-square-foot store right opposite Unity Plaza in Colombo.
Which is iconic.
Exactly. For anyone familiar with the local tech scene, Unity Plaza is the undisputed nervous system of retail IT in the country.
Right. So starting there and expanding out, it's the ultimate compelling entrepreneurial narrative. People love that story.
It's the dream. And it worked incredibly well. Fast forward to their August 2010 IPO, and PC House had captured a massive 25% market share.
In what was, at the time, Sri Lanka's fastest growing sector.
Yeah. They were ubiquitous. They had all these regional branches, massive government contracts, the heavy foot traffic.
They were the dominant player.
They were. And here is the number that should just stop you in your tracks. At the 2010 IPO, they went public with a market cap of 2.5 billion rupees.
That's a massive valuation.
Huge. And the IPO price was 11 rupees. Retail investors absolutely flocked to it.
But if you look at the historical data, they weren't buying a financial thesis.
No, not at all. They were buying the logo on the storefronts. I was thinking about this, and it's like buying a car just because you like the paint job without ever actually checking if there's an engine under the hood.
That's a great analogy. It's so easy to mistake a ubiquitous consumer brand for a fundamentally sound balance sheet.
And relying on that brand recognition instead of financial analysis, I mean, that was their first fatal mistake.
It was, because the irony here is that while the brand was everywhere, the company's internal engine was already tearing itself apart.
Behind the scenes.
Right. And the most crucial part of this entire deep dive, the thing we really need you to understand, is that the destruction was entirely visible in the public disclosures.
It wasn't hidden.
Not at all. Investors were blinded by the storefront, so they just ignored the filings.
Okay, so let's dig into that rot. They have this 2.5 billion rupee market cap. They have the stated mandate from their prospectus to use that capital to build data centers and, expand IT services.
That was the promise to the public.
Right. But the moment the ink dries on that IPO, the money doesn't go to servers or infrastructure, does it?
No. It goes straight to the founder's brokerage account.
Which is just wild to me.
It is the core of the operational rot. We see a textbook, catastrophic case of founder distraction here. Rishan began aggressively pledging his PC House shares as collateral.
Okay, wait, for the newer investors listening, let's break down why that's so dangerous. Explain the pledging part.
Sure. So he was pledging shares to fund personal stock margin trading, Margin trading is essentially borrowing money from a broker to buy other stocks. And to get that loan, you use your existing company shares as the collateral.
Right.
So he wasn't taking out loans to fund business growth. He was doing it to fund personal stock market speculation.
He was essentially playing Wall Street bets with a publicly traded IT conglomerate.
Exactly.
I was reading through the source materials, and there's this one anecdote from his business associates that completely illustrates the chaos.
Oh, the meeting story.
Yes, they recalled being in a meeting with him, and in the span of a single 10-minute conversation, he placed 10 different stock orders.
10 orders in 10 minutes.
Yeah, with 10 different brokers. He was sitting there, literally staring at live market data on 2 separate screens, instead of managing his sprawling IT empire.
And you have to understand the systemic risk here. When a founder pledges his shares for margin, the incentives of the company completely warp.
Because his personal money is on the line.
Exactly. A slight dip in the broader stock market forces what is called a margin call, basically. The broker demands more collateral.
Right.
So suddenly, the founder's priority isn't running the core IT business anymore. His priority is artificially propping up his stock price to save his own personal wealth from being liquidated by the broker.
Which completely starves the actual business of leadership. And of capital. I mean, you can see exactly where the cash flow died.
It dried up everywhere.
Yeah. The IPO funds meant for data centers.
Yeah.
Never deployed. All 20-plus branches outside of Colombo. Shut down.
Think about the cash bleed of closing 20 retail locations.
It's massive. Breaking leases, liquidating inventory at a loss, paying severance. Even their dominant footprint at Unity Plaza, which used to have 10 showrooms, allowing them to control regional pricing power, that shrank down to just 3.
And it cascaded right into their institutional operations as well. Government contracts worth hundreds of millions of rupees went completely unfulfilled.
That part really stood out to me in the reports. There was a 300 million rupee equipment advance they secured from the government.
A huge advance.
Yeah, they received the cash, but they simply couldn't deliver the equipment. I mean, if a company gets a massive cash advance and still cannot procure the inventory, that is not a temporary sales dip.
No, that shows a complete breakdown in basic supply chain management. It means the working capital is gone.
Exactly. And it impacted the human level, too. I mean, their own staff went 5 months without being paid.
5 months. And this brings us to the ultimate structural red flag, which is corporate governance.
The board.
Right. When a founder goes rogue and diverts resources like this, the board of directors is supposed to be the emergency brake. They are the adults in the room.
But they weren't able to stop it.
No. By late 2012, all 4 independent directors, Mangala Boyagoda, Sarath Wickramanayake, Modaraj Tilakasiri, and Kuverida Zoisa, they quit in mass protest.
All 4 of them just walked out.
Yeah. They realized the board had been completely bypassed. They were just a rubber stamp for a sinking ship, and they refused to carry the liability anymore.
So the bottom completely drops out.
Yeah.
By mid-2013, the market cap plummeted from 2.5 billion rupees down to 412 million rupees.
A total wipeout.
And the finance costs, just the interest on the debt they were carrying, were eating up 20% of their top-line revenue. The share price collapsed to 1.10 rupees.
Which is 90% below the IPO price.
Right, 90%. But, as an investor looking back at this today, my initial thought is, wasn't this a massive secret? How could a normal retail investor possibly know this cash flow crisis was happening?
I have to strictly correct that assumption, because it is the most dangerous myth in retail investing.
Okay, explain that.
None of it was hidden.
Ah.
Every single warning sign, the heavy margin pledging by the founder, the exploding finance costs, the operational deficits, and the mass board resignations, it was all fully documented and legally filed in their public disclosures.
Wow.
It simply required reading the annual report instead of looking at the store signage.
So the information was literally right there in black and white, which honestly makes the psychology of the retail investor the most painful part of this deep dive.
It really is.
If the red flags were publicly available, why did so many people ride this stock all the way down to a 90% loss?
Because human beings are wired to fail at investing unless they use a strict framework.
Yeah.
It comes down to 2 major behavioral finance traps, the sunk cost fallacy and loss aversion.
Let's apply that directly to a trading screen, because I think every investor knows this feeling. It's that knot in your stomach when you're staring at the red numbers on your portfolio dashboard.
Absolutely.
You know the company is struggling, but clicking sell makes the loss real. It crystallizes it. As long as you just hold the stock, it feels like it's just a paper loss. Like there's still a chance for a miracle bounce back.
That psychological barrier right there is what took investors from an 11 rupee stock down to 1 rupee.
Yeah.
To sell a losing stock is to admit defeat, which damages the ego. And the timeline of this paralysis with PC House is heavily documented.
Let's walk through that timeline.
From the IPO price of 11 rupees down to 7 rupees, investors held on purely out of brand loyalty.
They saw the Unity Plaza stores and assumed the dip was temporary.
Exactly. Then, at 3 rupees, instead of cutting their losses based on the terrible filings, they tried to average down.
Oh man, buying more shares at the lower price just to make their average cost look slightly better on the screen.
And then, at 3 rupees, the company announced a rights issue.
Just to define that, for listeners who might be lucky enough to have avoided one during a corporate death spiral or rights issue, is when a struggling company essentially passes the hat around to its current investors. They ask you to buy newly created shares to raise emergency capital.
Right, they are asking you to throw good money after bad into a sinking ship.
And people actually bought into it.
Remercibly, yes. Some even bought more. Because the sunk cost trap had fully snapped shut, by the time the stock hit 1.10 rupees, they were entirely paralyzed.
They couldn't bear to actualize a 90% loss, so they became passive victims.
Yes. But as an investor, you have to realize that a thesis-driven investor would have seen it coming.
But wait, I hear this, and my immediate instinct is to look for a mathematical safety net. Like, if I just set a strict automatic stop loss, say, a hard trigger to sell my position if the stock drops 5% from my purchase price, wouldn't that solve the psychology problem?
Well, a tight mathematical stop loss might have gotten you out of PC House, but over a 10-year horizon, it would completely destroy your broader portfolio.
Really? Why?
Because market data consistently shows that tight price-only stop losses just shake investors out of perfectly good long-term compounding positions due to normal market volatility.
Oh, right, because markets just naturally fluctuate.
Exactly. Instead, a thesis-driven investor uses a stop loss that is anchored to business fundamentals, not just price. You don't exit just because the price dips.
Right, you exit because the story changed.
You exit because independent directors flee, salaries are delayed, contracts fail, and founders pledge margin shares. That fundamental exit happens long before 90% of your capital is destroyed.
Right.
If you are a new investor on the CSE right now during a fuel crisis, with your portfolio falling and you cannot explain why you own the stocks you hold, PC House is your warning. Optivest Investing Sri Lanka does this every week. Subscribe now. The next PC House is already listed.
That is exactly why we are pulling these specific filings today. Because the mistakes made in 2011 with PC House, they are not historical artifacts.
None at all.
They are actively repeating themselves right now in our current macroeconomic climate. We have to look at the reality of 2026.
The current situation requires intense forensic scrutiny. We are dealing with the 2026 Hormuz closure.
Right.
The IMF has issued stark warnings about negative supply shocks, massive inflation, and global recession risks.
Let's break down the mechanics of that Hormuz closure and how it directly impacts companies listed on the CSE. The Strait of Hormuz handles a massive percentage of global oil. So a closure means instant freight rate spikes and energy shortages.
Immediate pressure.
Right. And if you are a local company, your supply chain relies heavily on imported fuel, whether that is for shipping, logistics, or just running diesel generators to keep your factories open.
Your operating costs ballooned exponentially.
Exactly, driven by foreign currency and global oil prices. But if you are only selling goods to domestic consumers, your revenue is capped in local rupees.
It creates a brutal margin squeeze, and this is where the parallel to our PC House deep dive becomes incredibly urgent. The target profile for the companies most at risk right now looks exactly like PC House did in 2011.
That's the scary part.
They are recognizable consumer names. They carry high debt, they have heavily pledged shares, and crucially, they have founders distracted by secondary objectives.
So for an investor looking at their portfolio today, watching their local consumer stocks slide down, the main question they're agonizing over is, will the stock price recover?
But that is fundamentally the wrong question.
Okay, why is that the wrong question?
Because focusing on whether the price will bounce back is exactly the psychology that trapped the PC House investors at 7 rupees and 3 rupees and 1 rupee.
Right. They were hoping for a bounce that never came.
Exactly. The right question, the forensic question is this. Does this management have a tested balance sheet, clear capital allocation, and governance that will survive a crisis?
And PC House had none of those things.
None. And the annual report proved it.
Okay, we need to make this completely actionable for the listener. To prevent catastrophic losses during this current energy shock, you basically have to become a forensic analyst of your own portfolio.
You do.
You cannot rely on brand recognition, and you cannot rely on hope. So let's walk through the framework. You have a 5-question test that every investor must apply to every single stock they currently hold.
Yes, 5 crucial questions. Number 1, do you understand how the company makes money at the business level, not just the top revenue line?
Right, because top-line revenue is vanity, especially in an energy shock. You need to know their actual cash engine.
Exactly. Number 2, is the founder pledging shares as personal loan collateral?
Because if they are heavily margined, their personal financial survival is no longer aligned with the company's long-term health. They're just managing the stock price.
Yay. Number 3, have independent directors recently resigned?
I mean, we saw what happened when the 4 directors walked out of PC House.
They are your canary in the coal mine. Number 4, did the company actually fulfill its IPO promises within 2 years?
So if they raised capital for data centers and didn't build them, their forward-looking guidance is meaningless.
Spot on. And finally, number 5, at what specific business condition, not price, but business condition, would you exit?
You have to define the breaking point before it happens.
Exactly. Write it down. Act on pre-planned logic, not panic.
When you lay it out like that, the realization is staggering. PC House failed all 5 of these tests simultaneously.
All 5?
But no one noticed because they refused to read the annual reports. They just relied on the logo above the door at Unity Plaza.
Which brings us to a final, vital warning about the dangers of emotional investing versus forensic data analysis. It is very easy to look back at 2011 and arrogantly assume that only amateur retail investors fell into this trap.
But the historical CSE data tells a much darker story.
It does.
This detail in the source material genuinely shocked me. Immediately after those 4 independent directors fled PC House in mass protests, which should have signaled the end of that, the government's own Employees Provident Fund, the EPF, shockingly stepped in and bought 7.5 million shares.
That's the worst possible time.
Yeah. If the smart institutional money can succumb to poor governance and brand hype, the everyday retail investor has no choice but to build their own strict forensic exit plans.
You have to protect yourself. PC House was not destroyed by a crisis. It was destroyed by debt, distraction, and a board that became a rubber stamp. The investors who lost 90% were not unlucky, they were uninformed, with no exit plan. In the current crisis, that combination is still lethal.
This is Optivest Investing Sri Lanka. We read the reports so you don't have to guess.